Welcome back, everybody. It's good to have you to another real estate market update for the Greater Milwaukee area, this time August 2023. Lots of interesting stuff to talk about today. I want to get started with the most important thing, which I believe are mortgage rates. They have hit another record 21-year high. So if you haven't heard about it, you'll definitely hear about it tonight in the evening news. I want to take a level-headed look at what that actually means in dollars and cents for us here in the Milwaukee market. And then also want to take a look at something that is not discussed so much in the news anymore, and that is inflation, what the Fed is currently doing and planning, and what's generally going on in the economy, because that is going to define what we are going to see next here in the Milwaukee real estate market. But before we get there, let's take a quick look, as always, at the latest numbers straight out of MLS. I have your July numbers compared to last year July, and below you have as a benchmark year 2015, which was the last time when we had a neutral market. Right now we're obviously in a very, very dominant seller's market. Inventory, no surprise here, it's been like this for the last few months here. So only 3,052 units on the market. That's down another 7.9% compared to last year, which was already very, very low inventory. So we're even below that. And you can see 13,000 units would be a normal inventory we would expect this time of the year. With that, closed inventory very low. We're seeing a very compressed market. Only 2,094 transactions have closed in July, which is down 21% over last year. And this is not for a lack of buyer demand. There is a lot of buyer demand out there. And the reason why we're only seeing 2,094 units closed is just because of the lack of inventory. And things are moving very fast. So we still are at 5 days on market. So there is no change from the previous months. If you've been following my channel, you know this. And we won't go much lower than this, because this is kind of how long it takes to physically move a property through the process. And with that, prices are up again, $325,000 now for a median home in the Milwaukee area. That is still quite a bit less than the US average, but for us here in Milwaukee, we're not used to this, so this is actually a relatively high price, plus 7.6%, and you see below 180,000 was the median back in July of 2015. So where are we at overall with the whole thing? I would say we're already past the peak for this year. We've seen the peak of the market probably in the third week of June. July is always a little bit lower. It's typical, 4th of July, people take off, there's vacation season, etc. So this is a normal seasonal pattern that we see every year in Milwaukee, that things simmer down a little bit, cool down, if you will. Well, in this market, you can't really talk about cooling down, but it's less crazy than we have seen in the spring market. Still a very high velocity, still competitive, but less than what we have seen in May and in June. And we're also seeing a much more predictable normal pattern after the crazy years. I call them unicorn years, 21 and 22, because of the implications of COVID. We have really seen some turmoil in the market. So now we're returning to a more stable, a lot more predictable pattern. And if you follow me on a monthly basis, then you can see what the numbers are equating to, and you kind of get an idea of what you can expect next year. But with that, let's take a look at the big topic, and that is mortgage rates. So little over 7% here for a 30-year fix. That's the big news at the moment. I don't think it's that much of a change, because you can see here, these are the last 12 months, and you can see we've basically been in this territory for the last year. The last time we were over 7% was end of October last year. Of course, everybody was sticker shocked because we came from 3%. So this was new territory, but we are relatively used to 6 and 7% mortgage rates. That's already priced into the market. The question is, what is going to happen from here? Are we going to see rates going higher? Dare I say it, 7.5%, 8%? Or is it possible that this will be actually the peak in rates and we will see rates coming down? So I will talk about this a little bit later. Zooming out here, I want to give you a little bit bigger picture of mortgage rates. This is the last 20 years. So you can see here we are here quite a little bit higher than we used to be in a long time. I think this is around when I bought my first house and also my first investment properties. 6.5% mortgage rate at the time seemed like a really good deal. But of course, if you are used to rates like this here, then this looks quite dramatic. Now let's take a look what these types of mortgage rates actually mean for a borrower in dollars and cents. I have an example here for you, a $100,000 mortgage financed over 30 years with either 5, 6, or 7% mortgage rate. Here is how your principal and interest payment every month is changing or increasing with rates. Obviously, this does not include escrow for your property taxes and your insurance, so that's not included here. It's just your loan payment. And basically the takeaway here is for every 1% that mortgage rates are changing on a $100,000 loan, you're seeing a change of $63. So that's either what you're paying additionally or what you can save if rates go down by 1%, about $65 per every $100,000. So to make this a little bit more tangible, I have here two examples. Here's a $250,000 property, $500,000 property, kind of typical for what we're dealing with in the Milwaukee area. 20% down, financed at 7%. Here's your principal and interest payment. And here is how this is monthly changing for either 1% mortgage rate change, either more or less that you're paying depending on what the rates are. So per month, this is not maybe that much, but when you actually add it up over 12 months or even over 30 years, this adds up to be a considerable amount of money. So financing at a good rate is absolutely critical. And that is a question I know a lot of people are wrestling, and there's a lot of my clients are debating this. I know they're, one spouse is the more fiscally orientated one, and they're like, "You're crazy, the rates are so high." And the other spouse might be saying, "Yeah, but our family is growing, we need a bigger home, etc." So if people don't know what to do, they usually do nothing, at least for a while. And a lot of families, I think, are staying put right now. Maybe for another year, they're not putting the house on the market because they say, we just want to see how the mortgage rate situation is panning out. Now, the question really becomes, what is going to happen with home prices? Because if you are waiting, let's say, for 1 year and home prices continue to, at least slowly increase, we've seen more than 5% increase year over year in the last years. But if you assume a 1% increase in property price, you have a substantial difference in your property price. So you're saving a little bit on interest, but you could be paying quite a bit more because of higher purchase prices. Now, there are also circumstances where it makes sense for you to wait until, let's say, next year. And that really depends on your personal circumstances. And, then I can tell you, I would do this or I would do that. So it really depends on your personal situation. If you want to reach out to me, a lot of people contact me with an email after they've seen one of my videos. You have here my email address on the bottom of the screen, m.auerbach@kw.com. We'd love to hear from you with your random questions around Milwaukee real estate. Happy to answer that. And also, if you want to book a phone call or a Zoom call with me, super easy to do. You have the Calendly link here on the YouTube descriptions just below this video, and you have access to my calendar, and then you can see what times I'm available, and you just book an appointment with me at a time that works for you. It would be a shame if you don't. I just last week ran into a lady in Shorewood, and she says, "Hey, you're the guy from YouTube. We watch you all the time. That's really good advice, and we bought a property. And we wanted to reach out to you, but we figured you're too busy." So let me state this here once and for all. I'm never too busy for answering your questions or talking with you. So if you want to give me a call or send me an email, please do so. That's why I'm making all these videos. All right, let's take a look with what else is going on in the Milwaukee market. So inventory-wise, we are seeing a slow increase. This is very much what we had anticipated and predicted. In June it started, July was the progression of this, and I think we're going to see a little bit more inventory piling up. The problem is, or the caveat with this is that new listings have already over the peak. So you can see this is listings that are coming new, fresh on the market every month. And we've already peaked here in June. July already went down, and August numbers are probably a little bit lower. I expect new listings to go up a little bit again in September. We have a few new listings coming up in the next few weeks as well. So September might be good, but then from an inventory point of view, it's going to be more of the stuff that hasn't previously sold and not so much new supply of new listings. Sold to list ratio is something that I have discussed recently in detail in a video that was called the 3 hottest markets in Milwaukee. So if you're not familiar with the sold to list, check out that video. basically what it says is how much are people paying over or under list price. And historically, this has always been around 94, 95, 96%. So on average, buyers were able to negotiate a little bit from the seller's asking price. Now we're in such a heavy seller's market that we are seeing people paying on average about little over 103% over list price. And this is something that we have seen in the last 3 years as well. So it's not a real surprise that we're seeing this. This speaks for the increased or for the very strong demand that we have on the buyer side. And as long as we are over 100% sold to list ratio, it is very likely that we're going to see property values and prices go up just as a consequence of this. Now, let's take a look at some economic factors, because that also has a big impact on what we can expect. And you will remember last year in the news, the big topic was inflation. In the last few months, we haven't heard much about it for the very simple reason that inflation has come down. You have here in blue the consumer price index, and we also have the personal consumer price index here in green. So both metrics are coming down. The Fed is targeting here 2.0% or less than 2% inflation. And they have made quite a bit of progress in getting there. But they are going to continue. So we have the next Fed meeting here coming up in September, and Jerome Powell is probably going to announce another increase in the Fed's funding rate to keep driving this down. And the reason I think why he's doing this is he wants to make sure that inflation is really dead. It's a very difficult beast to kill. And it always reminds me to like a Hollywood movie where you see the bad guy being shot and then the good guys walk away, and then miraculously he's not dead, he's just wounded and comes back. So we have seen this here in the 70s actually play out with inflation going really high, and we got it under control, but we celebrated too soon. And it came back and it really shot up here to almost 15%. So I think this is what the Fed is trying to avoid. They want to make sure they're driving this thing all the way into the ground, and we're well below the 2%. So I think they will continue to have a very restrictive monetary policy, will continue to raise funding rates, which is not directly mortgage rates, but indirectly has an impact, and drive the economy into, well, maybe a mild recession. They call it a soft landing. We will see how it pans out. Job market is still very, very strong, so no concerns from that end. But the mortgage rates are really starting to have an impact on the market. And mortgage rates are very, very important because real estate transactions and everything that is related to that account for about 20% of the US GDP. So whatever is happening in the real estate market has really an effect on the rest of the economy. Think on furniture, movers, and all the expenses, painters, that is related to when somebody is moving. The chart that I have here shows you how mortgage rates are trending, bonds and also inflation. So the blue line here is the inflation. You can see this spiking up here, and the green line is mortgage rates, and of course we're higher. And you've seen this in the past always. There is a lag of a few months, maybe half a year, before it starts responding. So it took a while for mortgage rates to actually go up, and it will take a while. We are going to see a lag before they start coming down. We just don't know what that lag is going to be. So a lot of confusion always how the mortgage rates come together. I've spoken about this extensively in previous videos, just a very quick recap. So over the last 50 years, the 30-year fixed rate mortgage, which is the green line here, is kind of always riding on top of the 10-year US Treasury. So that's a bond. And the average spread between those two is about 1.72%. At the moment, bonds are running high, so that is pushing up mortgage rates. But we also have a much, much higher spread. We have a spread of about 3. That is a premium that banks are charging because of the economic uncertainty. And the logic is when that economic uncertainty is vanishing, then that premium, that spread, also can come down, which would have a significant effect on mortgage rates. And as a consequence, they would come down. So at the moment, we have a very unusual spread between the 10-year Treasury and the 30-year fixed rate mortgage. And how unusual that is, you can see on this 50-year chart only very, very few times in history, in exceptional, extraordinary circumstances, we have seen a spread over 3. And that's where we are right now. So the banks are charging basically a 3% premium. And we don't know how long we're going to stay there, but chances are it's not going to be forever, just based on what we've seen over the last 50 years. Now, there's a lot of debate over what mortgage rates are going to go. I think in the media we will see discussions. What does it mean if they go to 7.5%, even 8%? And it's possible, nobody really knows short term what's going to happen. But I have some data here from you. So these are the forecasts for the next 4 quarters from Fannie Mae, from the Mortgage Banker Association, and also from the National Association of Realtors. And then over here on the right side, I have the average of all 3 of them. And so they're forecasting a little bit lower rates towards the end of the year, fourth quarter at low 6s. And then for the second quarter of next year, 5.9%. And if that were indeed to happen, then we're in for an absolutely crazy spring market. Spring market in Milwaukee is always crazy. But if rates go below 6%, that the 6 in front is kind of the psychological mark. As soon as you got a 5 in the front, a lot of buyers who are currently on the sidelines will step back into the market and take advantage, because if you're going from over 7 to 5 something, that seems like an opportunity, and we will see a lot of action in the market. So a lot will depend on what rates are going to do. What's your strategy here? Ideally, I would say you buy a house when you have a good opportunity to buy it at a price that makes sense. If the rates are going sideways, you just wait. If and when rates are going down, then you just refinance. Don't let your timing of buying a house be driven by what mortgage rates are doing and waiting until rates are lower. If that is your intent and your plan, you just simply refinance. You can always do that, and that makes a lot more sense. Now let's talk about appreciation. So, and we are getting a little bit here into market psychology. So here you have the Case-Shiller index and appreciation that we have seen over the last 3 years, basically since March 2020. A lot of these metro areas have seen appreciation between 40, 50, and even over 50%. The average for the US national was 41.8%, and Milwaukee metro is right in there with 41%. So of course, when you see prices go up so quickly, so fast, and it was in some markets, it was really crazy, where they're going up 30, 40% in 1 year. Those are changes that are not sustainable. And of course, people started worrying about what will happen. Are we going to see the big crash? And I'm going back in time here a little bit. Here we have a news headline, one of many examples from end of last year. So this is from beginning of December in 2022. And Fortune was talking about the possibility that the home prices could crash by 20%. So now we have the benefit of hindsight. It's half a year later, we can look back. They didn't crash. We did see a lot of corrections in many of the super high-flying markets. So when you look at Austin, Texas, when you look at Boise, Idaho, a lot of these markets that really went up like this, they came down considerably over the winter. Milwaukee has actually not seen that, but it did have all that talk in the press and in the media had really an impact on consumer confidence. And Fannie Mae is tracking consumer confidence, what people are thinking, what will happen to home prices. And you can see here what the pandemic did. So I remember the time I was constantly on YouTube talking about, no, the pandemic is not going to crash home prices, against everything that was speculated a lot on social media. And just the opposite happened. It was induced by the pandemic, and we saw home prices going up a lot more. So end of last year, we've seen that anxiety build up again. So there was a lot of talk also on social media, on YouTube. I'm sure you've seen it, that we might see a scenario again of a 2008 crash. So that has been thoroughly debunked. We're not going there. And every month that we're spending in this market, which turns out to be a lot more stable and a lot more predictable. So we're kind of flattening out in our trajectory. consumers regain that confidence. And there is really no reason to believe that the housing market will crash. There's nothing on the radar. It would really have to be like a black swan event, like a nuclear war or something of that magnitude, or a pandemic that we cannot predict. So one of the reasons why I'm saying this, we're monitoring a lot of things, but one of the big arguments that was always brought up why home prices might be crashing was foreclosures. So you've seen this before. Maybe here's a quick update, latest data. This is foreclosures. We were peaking at 1.7 million foreclosures a year in 2010, and we're tracking currently at 186,000. So this is actually a below normal number. We should really be more closer around 300, 400,000 foreclosures in a year. So very, very few. So we're not going to see a wave of foreclosures. Let's take a look at another leading indicator that's a lot more sensitive than actually foreclosure. These are serious delinquencies. So that is when somebody's not paying their mortgage for 3 months. It shows up here. So that happens a long time before they actually go into foreclosure. And you can see that even these indicators are trending in a very, very favorable way. So you can say, unfortunately, not a source of additional inventory, but the wave of foreclosures a lot of people were talking about is not very likely to happen based on this. What's going on with buyer demand? Here we have showing time data with very, very precise data on the showing activity in Wisconsin, how many people are looking at houses. The orange line is the current year, and you can see we're still tracking above the 2 previous years. This was the crazy year 2020 when we had lockdown and then catch up, so this was really unusual. But buyer demand continues relatively strong. We're just a little bit down from where we were in spring. And this here is a buy box, a box of opportunity, where you still have relatively good inventory, still a decent supply of new listings coming on the market every month. And prices and competition is usually below of what we have seen in the spring market. So if you got frustrated earlier this year, now in the next 100 days or so might be a good time. And then this is really marked at the end here by Thanksgiving, and then we're off to our annual holiday season. So that's the opportunity that we have. And with that, a lot of people are wondering, with all that information, what should I do now? Is it better to wait? Should I do something this year? And here's what I would say. Buyer confidence or the general consumer confidence has a big impact on the real estate market, of course. And I think buyer confidence will increase as we continue to be in this relatively stable market. We keep going down this path of low inventory, slowly increasing prices. People are getting used to this. Is just how it is. And the longer this goes on, the more confidence they will have. The other thing that is happening is that mortgage rates are expected to trend lower at some point in the future. We don't know if that is in 6 months, if that is in 12 months. Nobody knows, nobody can tell. But each one of these things have the potential to really drive the real estate market into a more competitive state. And if both of them coincide and happen at the same time, maybe even in spring, when we typically have that boom anyways, then that will spark a lot of activity and a lot of competition. So that's really the question: how are these things going to change and behave over the next few months? So based on what we know today, here's what I can tell you. The best time to buy is likely going to be for this year, for all of this year, even looking back. The best time to buy is going to be August, September, October, and a little bit into November. The best time to sell is probably next year in spring. So if you already have a house and you're trading into a different house, that is a logistical problem, because unfortunately you would have to carry 2 mortgages through the winter if you want to take advantage on both ends. So it's a little bit of a tricky situation on which side you want to benefit, because you can say, all right, I'll wait until spring to sell, because then I'm going to get likely a little bit of a higher price than I get now. And that also means that in that market you're going to have to buy, which means brutal competition most likely. On the other hand, if you're going to buy this year in fall, then you're also going to sell. So the market you're buying is always the market you're selling. So this poses a little bit of a logistical conundrum, and it depends a lot on your personal situation, what's going on with your family life, your financial situation, your job situation, how the kids, what's going on with them and with school. So I'm going to make a separate video on this because we're already way over time here and I want to be respectful of your time. If you're interested in this, I'm going to make another video in the next few days that is specifically going to talk about what should you do first, buy first, sell first, what are the advantages, what are the disadvantages, what are the things to consider. So look out for that video, that's going to come soon. So what can we expect for the next few weeks? August will remain moderately competitive, less than what we've seen in spring, but you still have to expect multiple offers on the nice listings, so competition is still there. Prices will continue to rise. We have seen prices go up every single month this year, and we're going to see this, but it's going to happen on a slower pace than we have seen it in the spring market. Slightly more inventory, but also fewer new listings, so there will be less and less listings to choose. And the big wild card is, of course, mortgage rates. Are we going to see higher rates this year, maybe even 7.5%, 8%? Or is this the peak that we've seen and they're already starting to come down after this? Nobody knows. We will see, and I'll keep you posted on all of that. But that's all I had for you today. Thank you very much for watching. Don't hesitate to reach out to me. You have my contact information here on the screen. You can send me an email or shoot me a text, give me a phone call, whatever works best for you. Thank you very much for watching, and I'll see you next month.